Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us is Ryan McCormack, factor and core equity strategist over at Invesco. We're going to review Nasdaq-100 weekly performance and also take a look at valuation in the index, certainly a theme that has been a big part of the market, certainly over the past 6 months. Ryan, it's great to see you as always. Welcome back to Trade Talks, and let's briefly discuss what you saw in the Nasdaq-100 this week and the broader markets overall.
Hey Jill, it's great to be back, and a good week for QQQ and QQQM, up 7.41%, better than the S&P 500, up 4.87%, and S&P 500 value up 3.11%. The theme of last week, risk was back on, particularly as you look at Thursday, and then even more intense on Friday. After the Fed's preferred inflation gauge, the PCE deflator, came in on Friday, year-over-year growth of 6.3% in April. That's down from 6.6% in March, and represents the first decrease in that figure since November 2020. Beyond that, the core was up 4.9% in April. That's down from 5.2% in March. 2 consecutive months of slowing figures in the core. So it seems as though a lot of those economists' forecasts for peak inflation in March, it seems to be correct. Markets took some comfort in that. And again, we saw risk on and interest in growth stocks and sectors. Today, sort of back to interpreting headlines of the JOLTS jobs opening were higher than forecast, although lower than the revised higher March number. And we saw a solid ISM manufacturing print at 56.1 against a forecast of 54.5. So still showing, solid expansion in the manufacturing side of things. It's still a pretty hot economy, and investors' concerns around potentially more hawkish Fed action in response is sort of this back and forth action that we've been seeing today.
Right, and speaking of the risk-on mood that we saw last week, what were the sectors that outperformed?
Yeah, so all 7 sectors in QQQ finished in positive territory for the week. All sectors in the S&P 500 were up for the week, but certainly saw the preference for growth, sort of that relief rally. Discretionary tech and communication services in that order, the best performing for the week. Discretionary was up 15.71% in QQQ, kind of led by Amazon rallying by around 15.5% and Tesla advancing by 20.71%. Overall, we only saw 10 holdings in QQQ in negative territory for the week.
And Ryan, let's wrap up here with your last chart here, and we take a look at valuation within the Nasdaq-100, because that really has been a big part of the narrative. And quite frankly, valuation did have to be reset and brought back down to earth here a bit. But you know what, Ryan, there are some pretty interesting stocks in there where their valuations really do look like value.
Yeah, we saw Nasdaq-100 valuations sort of, expand rapidly, more so than we've seen in the past number of years back in kind of Q2 of 2020. And, we saw trailing 12-month PE touch 40. And that's been sort of the biggest pushback, right? I think folks were worried about valuation. And, in looking this year, we've seen Nasdaq-100 valuations retreat pretty considerably. On a trailing 12-month basis, we're at 26.3. On a forward basis, we're at 22.4. That's slightly higher than the 10-year average, trailing 12-month of around 25.13, and forward at 21.4. On the 20-year average, we're actually cheaper on a trailing 12-month basis, and again, a little bit higher on a forward basis. But the point being, much more in line with these historical longer-term averages. And amidst all of this sort of retreat in valuation, we've seen a lot of these defensive sectors and names get bid up. And in looking at some of the data, you have Procter & Gamble trading at 25.3 on a trailing 12-month PE basis, forward PE of around 24, with 5.16% year-over-year EPS growth per the most recent quarter. To put that in perspective, Apple is trading at a 24.33 trailing PE, so cheaper on a trailing basis, 24.38 on a forward basis, so a little bit more expensive, but EPS growth of nearly 38% on a year-over-year basis. So you're talking about more than 7 times the earnings growth. Alphabet is probably even more stark at a 22.01 trailing 12-month, forward PE of 17.3 roughly, and 47.7% year-over-year EPS growth. So you've sort of seen now the defensives get bid up a little bit. This aversion to growth has brought valuations in many cases, at fairly attractive values. And if they can keep up the earnings growth figure that we've seen, I think it represents real opportunity here.
All right, Ryan, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.